Welcome to the Passive Investing Made Simple Masterclass. I'm your host, Whitney Elkins-Hutten, Director of Investor Education here at PassiveInvesting.com. And I'm excited that you've joined me today for this live webinar that we do every Tuesday to help you learn the ins and outs of passive investing. And so if you haven't done so already, make sure to join me at PassiveInvestingWithWhitney.com. There, I've got some free goodies for you. Also, if you are interested in learning how passive investments can help you meet your passive investing goals, how you can lever real estate investments without having to be an active landlord, be sure to check me out at PassiveInvestingWithWhitney.com. Now, today we are going to talk about the 10 questions that you should ask before investing in a passive real estate deal. Now, these questions aren't the only questions you should ask. Okay, these are going to be grouped in large categories. Okay, it doesn't count necessarily as due diligence, but this is the overarching, buckets that you need to address before you actually get into a real estate deal. And quite frankly, these are the top 10 questions we get when we talk to investors here at PassiveInvesting.com. Now, if we haven't met already, my name is Whitney Elkins-Hutten. I'm the Director of Investor Education here at PassiveInvesting.com. And I've been investing in real estate since 2002. I started off as an active real estate investor, focused on live and flip and house hacking. I got into that completely by accident, and then eventually transitioned into buy and hold real estate when I wanted to figure out how to actually unhook my income or how I earned money in the world from the time that it took me to make it. And so scaled a significant single family rental portfolio from there, then got into multifamily investing and then eventually larger multifamily deals. And then that's really when I discovered the power of passive investing. I like real estate, but I loved the power of real estate and what it could give me from a standpoint of preserving my capital, creating cash flow, creating equity, generating tax benefits, using leverage to build my wealth. And in the end, it's really my passive portfolio that has allowed me to spend or have freedom and choice on how I spend my time. And this is where I choose to spend it, is with my crazy crew here doing traveling. And these are some pictures from our most recent travels this summer. Fast forward to today, in my portfolio, I have over 6,500 residential units, 2,200 self-storage units, and 15 express car washes. But again, it's not about the numbers that we acquire in our portfolio, but what they give us. What is that result? And that is essentially, most people are after the financial freedom part, but what does the financial freedom give you? It's really the ability, the freedom and choice on how you spend your time. And we can help you do that here at PassiveInvesting.com. With over 331 million lent in our rehab wallet loan side of the business, 1.4 billion assets under management, and strong returns to our investors. Now, we are going to be going over the top 10 questions that you should be asking prior to getting involved in a passive real estate deal. But these webinars are really for education only, and nothing in here should be construed as financial advice, tax advice, legal advice. So make sure to consult with your investing team before going into any passive investment. Now, we're going to go over just the top 10 questions that you should be asking before getting in any passive deal, specifically passive real estate. But we're going to put them into some buckets. Now, this isn't due diligence necessarily, but what are those the top 10 questions that you should be asking and really starting to kind of dive down and digging further on? Well, as always, the first bucket of questions should be tailored to making sure you understand your needs. Okay. What do you need from your portfolio? What are your goals, your risk tolerance, and your time horizon with investing? Okay. That is probably the number one area that I see investors go awry when it comes down to their passive investing, is that they get into deals that did not actually align with their actual portfolio goals, their risk tolerance that they're willing to take, and the time horizon that they need to earn those returns. Okay. Once you understand that, now you need to know, what do I need from my investments in order to meet these goals? Okay. Now that's a little bit different spin, because really what we're trying to do here is create an alignment. Okay. You might say, I want to earn, 15% cash on cash annually, and I want to do it in 3 years, but I want to take zero risk to do it. We actually need to create alignment here. And we need to have some investments that are in our portfolio for today's dollars, and then also investments in our portfolio that help us achieve our longer term horizon goals. All right. Our next bucket of questions here really should start digging in at making sure that we're evaluating the sponsor. Okay. The sponsor, the operator. I personally love going direct to the operator to invest, but you might, consider going through a capital raiser as well. Really, at the end of the day, we want to know, what is that sponsors or operators? Who are they? What is their track record? Do you understand their experience and past performance? Have you done your due diligence to make sure there's no legal action being taken here, no fraud, no regulatory issues that are at play here? Okay. And then number 4, what is the business plan for the property? All right, so this ties into the sponsor as well. Most sponsors are going to have an overarching business plan when it comes to their properties. They're either, largely going to focus on core assets, meaning kind of, they just buy the assets, they sit on them for like 5, 7, 10 years, and then exit the deal, let natural market appreciation do its work. Maybe they're looking for some sort of way to create value in the asset and do core plus or a value add strategy. And then you get into your, riskier asset strategies, which are like ground up development, or maybe even land entitlement, land banking into development. Okay, so understand who the sponsor is and what is their core business plan that they like executing. Again, we're driving alignment here. Okay, after that, you need to understand the investment structure and the risk. And so there's 2 key questions that investors should be asking in this area. And that is, how is the investment actually structured, right? What are the different layers of equity? Like, how is it being structured? What are the preferred returns, the waterfalls, and the fees? Who makes what money when, and when does it get paid out? Okay, where do you as the limited partner fall into that payout structure? Number 6, what are the risks and how are they being mitigated? All right, what are the risks in the deal? How are they being mitigated? Now, are there certain market risks happening here? Are there interest rate risks, occupancy risk, expense risks? Okay, how is the operator choosing to mitigate each one of those areas? Because here is how we make money in real estate deals. It is solving issues. And so, yes, if we're going to go into, say, like a core plus deal or a value add deal, we're largely taking on issues as the operator. We're taking on properties that have some sort of fundamental issue and we're looking to solve them. But we want to make sure that we have done our due diligence on the property and that we started putting safeguards in place in order to mitigate these issues. And one of the ways that helps us mitigate those issues is making sure that we have enough capital, operational expenditure, and business reserves in order to mitigate those issues as well. Okay. Number 7, what are the projected returns and how are they calculated? Okay. Now, this is different than the investment structure. A lot of investors that I talk to, they come in and they want to know what the preferred return on the deal is. And they jot that down and they're like, ooh, I can, expect to earn a 7 pref on my deal. Okay. That is really just a hurdle for the operator to meet. Okay. That's part of the investment structure of the deal, of who gets paid what and when. The actual returns, you should be orienting around, what is your internal rate of return? What is the cash on cash that the deal is expected to generate in years 1, 2, 3, 4, 5, or longer? What is the equity multiple that the deal is being underwritten to? More importantly, let's not get starry-eyed by the numbers, but make sure that the projected returns of the deal actually align with your goals. So another risk that I see investors taking is that they actually will try to take a deal and make it fit their goals, as opposed to defining their goals up front and creating that investment thesis and looking for opportunities that match their defined thesis. All right, number 8, what is the exit strategy on the deal? Okay. Uh, and this kind of goes back to the business plan. Whenever you talk to the operator, they're going to have a core business plan that, most operators aren't, doing fix and flip deals or development deals, with shorter timelines, and also pairing them with like longer, 10-year holds. They usually have a niche that they specialize in and a playbook that they like running over and over and over again. So understand what those general exit strategies are and what the hold times are. And then as the operator, okay, great. If your first opportunity for exit doesn't pan through, do you have backup strategies? Essentially a plan B and a plan C. Okay, what are all the different ways that we could exit out of the deal? And not so much you as an investor getting your money back. Of course, that's what we want. But how can the deal be exited so everybody hits their return targets? Number 9, this is something that I really encourage investors to ask more questions around, is what is the communication plan of the operator? And this is something that we love and really pride ourselves on here at passiveinvesting.com, is are you getting a monthly readout or a monthly update? Okay, make sure you're getting some sort of communication around your project at a regular basis. Okay, and then that the operator is sharing financials with you, ideally on a quarterly basis. That should be pretty reasonable, but minimally on an annual basis. Now, here's the thing. I've talked to a lot of investors in the past year, and they say that they have an investment that's gone awry. And whenever you dig further, a lot of times that communication, there was a faulty, the operator was faulting, somewhere in the communications, or not sharing the financials with the operator. I have one deal in my portfolio where the operator, I have to go to them every single time I want to see a quarterly report. Okay, we want the operator to be forthcoming about that and make sure that they're sending out that as part of their regular communication plan. Another piece of the communication plan is making sure that you're getting a timely K1. So ask this of the operator up front. Okay. Now, K1s generally are due at the end of March. Okay, so it can make it really tough for you as a limited partner investor to hit that April 15th filing, even if the operator gives you the K1 at the end of March. So we encourage all limited partners to file an extension, because the last thing you want is an operator to rush and get you their K1 and then come back a month later and say, oops, guess what? We adjusted our return. Here's your new K1. All right. But we want to understand when that K1 filing happens, because if I also see this as an opportunity, how well oiled is that operator's systems? If they're waiting to give you K1s in, say, September, 4 months later, past the deadline almost, or 5 months later past the deadline, that might be an indication to me that they don't have the strong business systems in place that I'm looking for. Okay. And then as part of that communication plan, how accessible are the general partners? Should you need to escalate your questions? Okay. Most teams, we want to see scalability within the team. So initially you're going to engage with investor relations and investor services. But if you have a very directed question, or if you need to escalate an issue, how readily available are those general partners? We want to see good availability. And then also kind of in this bucket is, what is the minimum investment in capital provisions? Okay. This is a question that I think investors should always ask before going into a deal. Is number one, what is the minimum investment? What should you be expected to put up? But also, what skin in the game do the general partners have in this deal? And how much are they allocating to the deal? Okay. Now, here's the thing. You, as a limited partner, always have a choice on who you invest with. Okay. And so for us, we love partnering with our limited partner investors and providing at least 5 to 10% of all limited partner equity in the deal. Now, again, these were the top 10 questions that investors should, at a minimum, be asking about their deal. Again, it doesn't constitute necessarily due diligence on a deal, but rather help you kind of hit the major categories so you can dig further. So, but remember, it all boils down to understanding your needs, evaluating the sponsor, making sure you understand the investment structure and that you understand the investment logistics and how you're going to be communicated with. All right, guys, if you're here live, don't go anywhere. We're about to start our Ask Me Anything part of the show. If you haven't done so already, make sure to check us out at passiveinvestingwithwhitney.com. There, we can hop on a free one-on-one call to discuss your passive investing goals, and you can see our open deals. Actually, I almost forgot here. If you want to get more information on how to dig in and align your finances with your passive investing strategy, you can check out also Money for Tomorrow on Bigger Pockets. All right, guys, we're going to move on to the Ask Me Anything part of the show. Thanks for bearing with me, guys. I'm having a little bit of arrow fumbling around here. So anyways, I would love to know, this topic today was meant to be short and sweet and provide the top 10 questions that investors should, at a minimum, be asking before they go into a passive investing deal. I would love to know your questions. So first, go to that chat box or your Q&A box. Let me know what you loved and what you would love to see, because it's really your comments, your feedback, your questions that fuel future passive investing masterclasses. So if you're sitting on a question, ask it now. It doesn't actually have to be related to today's topic. Let me get out of here. Oh yeah, well, no real questions. Thank you. Absolutely. Happy to help you here. What do I consider? Another question came in. What do I consider an acceptable split? So I think that's going to go back to how I read that. It's going to go back to do we understand the investment structure bucket of the deal? Like, what is the preferred return? What what kind of split or waterfall is happening between the limited partner and the general partner, essentially who gets paid what and when. Now, to answer the question directly, what do you consider an acceptable split? It boils down to what the investment actually is, the work and time involved, and the risk that's being taken. Okay, so I know limited partners, myself included, guys, and remember, I've invested in over 65 limited partner deals. I look for this too. They want to have the most favorable returns, but you want to make sure, just like you're trying to find an investment and match to your timeline and risk tolerance and goals, we need to make sure that the actual split that's being offered is aligned to what is happening in the deal. Okay, what do I mean by that? Well, new operators generally will offer better splits, right? They're building their business, they're trying to attract new investors, and then over time, after they nail their systems, after they kind of grow their operations using their investors' money, they'll start nudging the splits down, meaning you might start off with a new operator that's offering a 90-10 split. 90% of the profits of the deal go to the limited partner, 10% to the general partner. Okay, and then over time, they might start nudging them down to 80-20, 70-30, 60-40. I've seen 50-50 and even 40-60, okay? There's nothing wrong with doing that. You just need to know, number one, where is that operator in their growth trajectory in that particular asset class, okay? The more mature the operator is, the better systems that they bring, the more capital they're bringing, they're signing on the deal loan, they're doing all these things on behalf. I actually see that as a benefit, okay, if we are aligned. All right, so that's kind of number one. Number two, kind of response to that, is What kind of risk or work is the operator doing in the deal? Okay, so if an operator goes and buys an A-class building with nothing that needs to be done, meaning it's say like 95% tenanted, rents are at market rent, they're just going to sit on the building and do nothing, and they offer say like a 65-35 split or a 60-40 split, to me that doesn't align. Okay, they're essentially buying the building, managing the building, disposing of the building. They're going to get their fees in there too. Why are they taking such a big back end split? Whereas you have an operator who is taking on a project and they're going to do a lot of capital management. They're securing the loan. They're infusing a lot of capital into the deal. They have to handle lease up. They have to handle like reworking on the amenities on the deal. There's all these things they have to navigate in the environment and with the deal itself. Maybe that could warrant a little bit larger of a split being taken by the operator, just purely because they're putting more work into the deal and taking more risk, because that large check, that common equity check is coming at the end after they do all this work. Okay, so what do I consider an acceptable split? I want it to kind of put a pretty bow on this. It depends, again, on the operators, track record, their history, like where they are kind of in the development of their business, kind of part one. And the other part of that formula is going to be what is the work they're putting in on that particular deal? And you want to see alignment. That's the key thing. You want to see alignment. If you don't see alignment, then that's an issue. What other questions do you guys have? And was that helpful? That was kind of a short question, but a lot to unpack there. Oh, good, good. Yes, I'm glad that was very helpful for you. What other questions do you guys have? This is our opportunity here to get your questions answered. And so if you're new to the Passive Investing Made Simple Masterclass, we do this live every Tuesday. And so you have the opportunity to, get to know us better, get to know me better, but also, get your questions answered live in a forum. All right, I'll hang out here another minute. If you guys don't have any other questions, I really look forward to our conversation next week. We're going to talk about market cycles and how you can be taking advantage of the market cycles to capitalize and build your wealth in this environment. Question came in, how many years experience do you think is reasonable for an operator you would consider? Ooh, okay. So again, this is going to be another it depends question. Okay, but what does it depend on? Well, so there are investors that love they're more, I kind of see them more of like angel investors, like say like in the tech world. They're looking for the next diamond in the rough operator. So they're going to go in early in their business and invest with them so they can get amazing back end splits, build their wealth alongside them. Keep in mind the operator is scaling their business using that investor's dollars. Nothing wrong with it. Totally legal, totally upfront. Everybody knows what's going on. But that investors take an additional risk by investing with newer operators. They need to realize that. And I think that's the disconnect, is some investors are looking for that elevated back end split, the larger preferred return. And they're, kind of coming in with the mindset of the stock world, right? I'm looking for the biggest bang for the buck, the next Tesla or the next Apple or whatever. Okay, with experience, we're going to see an operator who has modulated their business. They have probably modulated their back-end splits. They've modulated their preferred returns. Okay, so they've really started, and the reason why they're able to do this is because they bring a larger track record and more experience and a bigger team and more experienced team to the table. Okay, I, as a limited partner, get to choose who I invest with. For me, I like sleeping well at night. I'd rather be with a more seasoned operator that has that experience and track record. That way I'm not nervous in any market environment. Really, does that operator have the background, the experience, the expertise in order to navigate the deal through choppy waters like the last couple of years have been? Okay. Now, if the operator, I know I haven't, so we answered it directly. It depends. I like operators that have been tested. And this market has been amazing for testing operators. Operators that are going to move through this environment have going to have handled COVID, probably some sort of hurricane, collapsed power grids, some sort of like weather related event. They've handled rising interest rates. They've handled a market downturn. Okay. So if somebody's coming in new today and it hasn't handled all of those things like in the past 4 or 5 years, that would make me nervous. But operators that have been around at least since, before COVID and are still operating today, they have probably taken a lick or two, but they've learned their business. I would be far more inclined to invest with them. Okay, so whereas before in 2019, we wanted to see somebody, ideally, like, our old school investors wanted to see somebody who had been through the financial crisis. This is our new financial crisis. So I want to see somebody who's been at least in business in the past, since before COVID, in the last 4, 5, 6 years. That's me. Okay, so hopefully I've answered that question both directly for you with it depends, but giving you a little bit more nuance on like how I think through this. Ooh, what would you consider reasonable preferred return percentage? Again, it depends. What is happening in the deal? Now, think about the preferred return is not a return at all. If I had my magic wand, I would actually eliminate the word return from that statement and just say preferred percentage. That's it. Because I think it causes a lot of issues, okay, and cognitive dissonance from some people. So when investors see preferred return of say 7%, they're like, woohoo, I get at least 7% of the deal. Yes, but that doesn't mean it all comes up front. Your cash on cash in year one could be 3%, 4%, 5%. Okay, so the rest of that delta is being accrued. Okay, or some operators don't accrue that, and so it just goes away. It goes poof. Like, what's the point of a preferred return? Okay, so that's also going to align to the market, the class of the deal, the type of the deal, and and a lot of things, the underwriting of the deal. So really what the operator is trying to say is when they offer a preferred return is they're like, we are going to give you the first X percentage of this deal before we start sharing in a split. Okay. The more seasoned operators, I mean, the people that have been around 20, 30 years, they probably only offer a preferred return if they do a 4, 5, maybe 6%. Okay, your more seasoned operators that have probably been in business 10 to 20 years, they're probably going to offer a preferred return of like 6, 7%. Okay, some of your newer operators, and some operators just in general, they don't believe in the preferred return. We're just going to like do a split and call it good. All right, so the preferred return just really is that operator earmarking a certain percentage of the deal that goes to the limited partner before they get to start sharing in splits. Okay. I still look for preferred returns. To me, like if there's not a preferred return, it doesn't necessarily stop me from investing, but it is a red flag. I want to dig in and know why. What's going on here? Like why is the preferred return not being offered? All right. A lot of great questions coming in. All right. What resources available to evaluate an operator? So I do the Passive Investing Made Simple Masterclass. We actually meet tomorrow. Tomorrow's Masterclass. I don't have that topic in front of me right now. Sorry, guys. But if you go onto our YouTube page at youtube.com, passiveinvesting.com, you can look up our previous master classes and boot camps. If you look at the boot camp series, there I repeat like 10 to 11 topics within a year. And you can go pick out the last how to evaluate an operator topic. That's where we deep dive and build skills. So you can watch that webinar, hour-long webinar, and you should be able to come out of that building your own operator due diligence checklist. Okay, that's the whole point of it. Okay, master classes are meant for us to kind of like talk about topics in like, 15, 20 minutes and then go into Q&A. I would go to that passiveinvesting.com, DOT.com, on youtube.com, look up that. Who can help review or offer an opinion on a particular offer? Well, my number one way is to get a coach or a mentor, somebody that you respect in the space that is doing what you want to do. Okay, not somebody theoretical, but somebody who's already done what you want to do, somebody who's already achieved financial freedom here, somebody who, again, who's been investing. I know a lot of coaches and mentors out there have only been investing in passive investing deals for the past 2 or 3 years. They haven't been tested through market downturn, COVID, just like an operator. So make sure you're, if you're going to go with a coach or a mentor, that they have done what you want to do. And they, a minimum have gone through the last 5 to 6 years of the market cycle. I do that personally with people, but some coaches and mentors will help you look at individual deals and walk you through like questions to think of. So that's one way. A second way is there are some, groups out there. I know Left Field Investors just recently transitioned to passive pockets. They're in the middle of that transition. I know some limited partners will put deals out there on those type of groups and ask for feedback. Here's the thing. I love those groups. And at the same time, you got to be careful of getting that, processing that information, because you might get feedback from somebody who doesn't share the same goals, risk, and timeline as you. So they might poo-poo a deal that you really were looking at that matches your goals, risk, and timeline. Conversely, you might put a deal out there and somebody might just be giving an opinion and have really no background, business background. There are people that just love typing on those forums. So you really have to be careful. Also, if you're in those forums and you see deals, I ran into this issue in my early investing career. I would go to forums to try to connect with operators. I would see deals and I'm like, oh, that deal looks amazing. And then if I would quickly realize I'm out of alignment because that person who put the deal in the forum didn't share my goals, risk, and timeline. Okay, so this is where I really love circling back to finding a coach or a mentor that is doing what you want to do, has done what you want to do, and really tapping into that power. What if another party has a preferred interest and the LP is behind them in the capital stack? That happens all the time. I mean, almost every deal that I know of, because, another party that has a preferred interest in almost every real estate deal out there is going to be the bank, right? It's going to be senior debt. Okay. That's one. I would love, John, if you want to expand on that question, I can kind of guess where you might be going with that, but if you want to expand on it, and I want to make sure I answer you directly, please put that in the chat box. But yeah, we're always going to be in a capital stack, almost unless you own the deal all in cash, you're probably going to be behind somebody. It's either going to be the senior bank or the senior debt position. Heaven forbid there's a mezzanine debt, a second loan, or a supplemental loan on the deal. Okay, now you got senior debt, supplemental loan, senior loan, or secondary loan, and then you're behind that. Maybe there's a preferred equity layer. Okay, maybe there's a promissory note. There's all different ways to kind of put this deal here. So other than the first mortgage, well, I mean, so in like 2016, 17, and through 19, right? I know a lot of operators were, and a lot of people were going after value add deals. And so the operator would secure the original purchase of the property with a Fannie Mae, Freddie Mac loan. And then after 12 months, they would do a supplemental loan to return investor capital. That is a second loan. Okay, now you get to pay off the primary loan and the supplemental loan or secondary loan. Okay, so that's adding another layer. So the limited partner got their capital back, kind of de-risked their position, but now you got, it's more challenging to exit the deal should the market go down. Now, what I think and thank you, I saw that second line that you put in there, John. So what's been happening over the, hold on, guys. I think I have a slide that if you give me a minute to pull this up, I think this will really help you visualize. It's in a presentation I'm due to give here in 20 minutes to another group. But I think this will really kind of help you visualize something. And I know, I see other questions come in, and I promise I'll get to yours. Okay, so we got a couple of different things like layering on top of each other, right? We've got recovery. We are in the hypersupply or recession. We're in the downhill slide of this particular real estate market, especially related to multifamily. As we come out of this, now we got recovery and expansion. Okay. How does this layer on credit cycles? Well, as we're going to hypersupply into recession, credit becomes less available. That's a really cool thing that we as investors now get to enter the marketplace. Bank money retreats. We get to enter the marketplace and take advantage of this less credit being offered. Okay. So we can start going into note positions, into preferred equity positions, into promissory note positions, right? Because less credit is available. We as investors get to solve that problem. We get to reap the rewards of it. All right. But what if you're a limited partner in a deal that needs this type of money, that needs a refinance, that needs a preferred equity layer, that needs some sort of capital infusion here? What are you to do? Like, oh my goodness, this added layer of money is being injected into the deal. What happens to me? Okay, so it depends on your PPM. Okay, what's outlined in the legal documents. And there's several different ways to solve that particular issue. But as a limited partner, if you're getting preferred equity brought into a deal or a promissory note brought into a deal, you might see some sort of, liquidation of maybe like a percent. It shouldn't ding you too much, but yes, you do have, the PPM is now going to reorient, the waterfall is going to reorient, and now you're going to, when the deal sells, you'll have to pay off the senior loan, you're going to have to pay off whatever, preferred equity layer, the promissory note, because the promissory note was, attached as a debt to the business that runs the deal. And then the limited partners are behind them. But you as a limited partner could, instead of being subject to a capital call, you could now also invest in this layer. All right, so there is an opportunity there, especially if you still believe in the operator in the deal that they can navigate that deal to the end. You could invest in this layer and you probably could boost your return and not actually see a dilution in your return. Okay, so just because we have those layers inserted doesn't mean it's hugely disastrous to the limited partner, nor that you can't actually can't earn a bigger return if you invested in those layers. Hopefully that makes sense. Do we want those layers to actually, want that situation to come up to begin with? No, ideally not, but they happen all the time. We see preferred equity get infused at the beginning of the projects, things happen with the market forces that, lead that to happen. And that can be a unique opportunity to get involved. If you need me to expand on any part of that, let me know, John. Otherwise, it's a huge, monstrous rabbit hole and we can go way down. What are factors to consider when choosing between vertically integrated sponsors somebody with their own construction team, property management, etc., versus sponsors that do not have these operations in-house? Ooh, well, great question. Pros is when an operator is vertically integrated, they have their pulse on all areas of the business. Con to that is, should they be doing that? It can be a distraction, right? I had one operator that started, they were well into growing their portfolio. They started their own property management company. They rolled it out. The property management company did really well, say like in the Texas market and in the Florida market, but when they started expanding into other markets like Georgia and Tennessee, they were just too stretched thin. Okay. Then I had another operator that I was invested with. They were really small, very small capital group. And then they decided they wanted to save a buck and bring in property management in-house. It was just a complete distraction from the very beginning. And they've actually ended up unwinding it. What we have done is different, especially on the multifamily side and on the self-storage side, is that we have third-party property management. Okay, we actually like that because now we get a independent set of eyes on every single deal that we do in the multifamily and the self-storage space. And so when we have our investment committee meetings, it's not just like one or two people deciding if we do a deal. It's an investment committee meeting where multiple people are looking at multiple models on whether the deal will work or not. Okay, and we get to blow holes. Like the property management company gets to blow holes in our model, we get to blow holes in the property management model, and then out of that investment committee meeting, we get the model that we run with. Okay, that is something that I really like. Okay, now, so hopefully that kind of gives you an insight. I would dig further. If I were evaluating an operator, I would want to know, like, is that vertical integration actually helpful to the business or a distraction to the business? Okay. And if it became a distraction, how would they then unwind that decision? And are they prepared to unwind that decision and go back to third-party management? And have they underwritten it into the model? Have they run the numbers that way? Okay. I think that has answered all the questions, guys. Amazing questions, as always. If you've got any last minute questions, pop them in over into the chat box or the Q&A box. I'd love to field those for you. Maybe give me, while you guys are formulating your questions there, if you give me just a second, I'll tell you what next week's topic is going to be about. Oh, it's going to be about understanding market cycles and how that impacts your investing for 2024 and beyond. So you guys just got a little bit of a preview of what we'll be talking about next week. All right, guys, if there are any other questions, thank you for taking the time out of your busy day, not only to invest in yourself and your education, so you can go into your next deals with confidence, but also spending it here with me. Super fun. As always, you guys take care, and I'll see you next week.